Hi, Dr. Jim. I'm Vivek.
Oh, Vivek. Hi.
He's Rahul,
Yes.
and we just thought that we would kind of talk to you around the budget that was just presented in India,
Yeah.
and some stuff on China, gold, and how you see the global economy going through this year.
Okay.
So
So yes, on the budget from earlier in the week, would I say that I was generally disappointed? Not really disappointed, but I think it was a fairly predictable budget in terms of the goals on fiscal consolidation. It was pretty well obvious that there was going to be no deviation from the fiscal consolidation path, because we know what Governor Rajan has said about interest rate cuts if the fiscal consolidation didn't happen. So I'm not quite sure how we get to a 3.5% budget deficit in the next fiscal year, but I'm pretty sure that the goal somehow will remain in place. And of course, the RBI governor is now duty-bound to produce some interest rate cuts in the back of that, which I think personally are way overdue and are required anyway. But the details of the budget, we were a wee bit disappointed that there wasn't more commitment to capital expenditure on the development side. And although good progress on things like the roads and rural programmes are obviously very necessary at the moment, given how bad the last couple of years have been in terms of farm incomes, I would have liked to have seen a bit more in the way of divestment, which would then fund a lot more of the infrastructure programmes that India so badly needs. So I think the thing I would say about the budget is that it was predictable and good in parts, but a wee bit disappointing in some areas. Not least, of course, the fact that goods and services tax just seems to be stuck at the moment, obviously with the first draft of the bill that went to Parliament, probably not the best bill that went to Parliament, but it really needs to be unstuck at some point so that the government finances get onto a much sounder footing. But I wouldn't like to be too critical of the budget. That's the thing. I think it was pretty predictable.
Okay. I can tell you for sure that as far as the fiscal deficit target of 3.5% is concerned, I mean, the assumptions are very shaky. He's been extremely optimistic on the revenue front, and the expenditure front, he's understated many things. I mean, and
that's potentially right. I've read a lot of the commentary, and none of it's been gushingly good. But in fairness to the commentators, they seem to be saying pretty much along the lines that you've just mentioned there, but the proviso being you might get away with it. How he gets away with it, I'm not quite so sure. The economy really needs to pick up steam a bit, I think, for the 3.5% to be realistic.
So, what other things would you have liked to see in this budget? I mean, what did he miss out on?
As I said, a difficult one for him, just in terms of the timing of it and the necessity to tell the RBI that fiscal consolidation was underway. But to be quite honest, I would have liked to have seen a bit more on the public sector banking recapitalisation. I know they're kind of waiting until the RBI sorts out the non-performing loans and makes sure that every bank is on the same page with the same non-performing loans. But I think that in order to get things moving in India, the public sector banks really have to be addressed and addressed pretty quickly. That would have been one thing that would have been quite high up my list. GST would have been another one, really to kind of clarify the timetable there and make sure that it was going forward. The states need to be brought into line on that. But having said that, I know there's a lot of good things going on under the surface in terms of the digitalisation of the public procurement process in India, about the subsidy distribution and effectively the payments to rural workers, etc., etc. These are all very positive areas. But we do still need quite a lot of infrastructure work over and above rural roads and railways. So, more commitment on the special economic zones, airports, ports generally, cold storage, which is a really vital part of transforming the Indian rural economy. All of these, I would actually have preferred to see a 3.9% budget deficit target and spending 0.4 percentage points more on these types of projects to get the economy moving.
Mm-hmm. You talked about Governor Rajan now more or less having to cut interest rates. Do you really feel that cutting interest rates does it make a huge difference? Because if you look at the consumption side of the retail loans, they continue to grow as they were, more or less 1-2 years back. It's the corporate side which is the problem.
Yeah, no, I hear what you're saying. The reason I would be very keen to see rate cuts, the way that we look at every economy, but for India as well, is we calculate what we consider to be the real lending rate. But our calculation of the real lending rate takes the lending rate prevailing in the economy and deflates it by the nominal GDP growth rate. So that the idea here is that if you've got an interest rate of 6% and your economy is growing at 6%, then that's a pretty kind of sustainable interest rate and a sustainable payment prospect, because your economy is growing at 6%, you should be able to meet 6% lending rate repayment. At the moment in India, the real interest rate or the real lending rate that we calculate for the corporate sector is running at +5. Now, we're relatively comfortable if it's +2. We're relatively comfortable about even as -2. But at 5 percentage points, that's a huge hurdle rate for any corporate sector to jump over. And what it suggests to me, and I think this is borne out with a lot of the decisions that have been made over the course of the last year or so, with the real lending rate at these levels, there is a reluctance of the corporate sector to make investment decisions, positive investment decisions. And the only reason that I would want to cut interest rates, and by the way, I think there's good reason to cut interest rates when you look at what money supply growth and credit growth have been in India for the last 2 years. The reason for cutting interest rates is to get that positive real lending rate down to levels that are much more commensurate with the corporate sector making an investment decision.
In fact, it would be more than +5, because nobody really believes the 7.6% real GDP growth rate that we have. So
no, admittedly, what we do is we take the nominal GDP.
You take nominal. So real and GDP nominal are more or less,
in line at the moment. Yeah.
So
I trust the nominal figures a bit more than I do the real
one, because we don't know what deflator is ultimately being used. I mean, that's where.
That's fair. And yeah, we're kind of, what would you say, we have no choice but to use some of the official numbers. But you're potentially right, I think, that certainly on the real side of GDP, I don't believe 7.6% for one instant. I think the authorities have made a real mess of the new GDP calculations. India is now just about as bad as China when it comes to real GDP. And that's a pity, because, you look at all of the other data, and I'm sure you're doing this all the time, Vivek, that industrial output...
Yeah, it doesn't seem like...
We know the rural economy has been in trouble for 2 years. Right. Industrial output can't get itself above 2 or 3%. And, just those two alone, when you put them together, to say that the general economy is growing at 7.6% just is a mighty stretch of the imagination. and either the services sector is booming like never ever before, or it's just a bad number. And I think it's just a bad number.
Yeah. In fact, the latest GDP data, the manufacturing side of it grew by around 12%. I mean, it's unbelievable.
Yeah, when exports are falling by 12%, yeah.
So it's quite sad. So I mean, you spoke about PSB, public sector bank recapitalization a little. So one idea that's been going around for a while is good bank, bad bank.
Yeah.
Which I think from whatever I've read of Dr. Rajan, he doesn't seem to be in favor of it because that comes with a lot of moral hazard. So what is your view? I mean, is it a good strategy to have a good bank, bad bank thing and kind of clean up quickly?
Well, I think what's going to happen anyway, Vivek, is that over the course of probably the next 2 to 3 years, whether there's a good and bad bank strategy, some of the bad banks are going to go. That's all there is to it. Who's going to buy them? I'm not quite so sure. Whether it's ICICI, HDFC, Yes Bank, Axis, or whether it's Baroda, and some of the
in fact, some of the smaller banks can just be shut down. A government doesn't need 27 banks.
Correct. So I think we've started some of the new banks, which are more kind of digitally orientated. I do think that the RBI is probably right in trying to get all of the banks on the same page about individual loans. I mean, there is absolutely no point in Bank A qualifying a loan as being non-performing and Bank B qualifying the same loan as being performing. That's just ridiculous, So they are going to get them all on the same page, but I'm not a big kind of fan of the good bank, bad bank model. I must admit. I think the fact is that the good banks are going to come out of the whole process very obviously, and the bad banks just need to go. And it'd be the best thing possible if the good banks took over some of those bad banks. And I'm pretty sure that's what's going to happen. I do think India used to have a very, innovative approach to banks with high non-performing loans and therefore troubled banks. And I don't really understand why they don't put much more emphasis on this again. If you remember, going back, quite a number of years now, the authorities used to define a bank that had run into trouble with too much in the way of non-performing loans as a narrow bank.
Okay.
And what the narrow banks were allowed to do was, with their deposits, they could buy government securities, but they couldn't do anything else.
Yeah, I mean, that would be a good way to go about it.
I think that's a useful model. It effectively takes the bad banks out of the system.
Yeah.
They might continue to get some deposits, but the only thing that they can do is recycle them into government paper. So they'll make a turn on it, but they're effectively done anyway.
Yeah, I think isn't that what the RBI is also planning with the payment banks? That they can't really do much except invest their money.
But the context is different.
Yeah, the context is different. But I'm just wondering, how far back was this whole idea about? This must have been like really far back, right?
This is the first time I have heard of it.
First time, never heard of it.
It's a long time, because I'll tell you where I read about it. The World Bank produced a book at one time on the Indian capital market structure. And this is probably 20 years ago. But one of the chapters basically kind of outlined the approach that had been used, and for the life of me, I'm not sure whether it was the 1970s or the 1980s.
Yeah, it's probably that far back.
It's a long time ago, where effectively the authorities forced banks to take this narrow bank approach. And when I read it, actually the World Bank was pretty open to this method of addressing bank sector problems. and was commended India for the approach that it took on that. And I think that a very similar approach would be pretty useful just now. As I say, what it really does is it kind of turns off the bad banks as a part of the system.
Mm-hmm.
And while it gives them some elements of being able to get out of problems, it just means that they're not capable of making bad decisions anymore in terms of loans to the private sector or even loans to public sector companies, because they're not allowed to do them.
I think one of the banks has been put under such a structure. I'm not sure. United Bank of India is currently under
United Bank of India. I think that's exactly right. I think that's a good way to go.
Yes, it makes immense sense. So on the infrastructure front, what more can the government do? I mean, you said you would have been happy to see more investment, so capital spending. So
yeah. I mean, don't get me wrong, I think they intend to do a lot. I'm pretty sure that the Highways Authority is going to be a bit more active over the next year or so. The rural roads is a good idea. There's obviously a number of rail links that have been on the cards, and I presume, I haven't been following them that closely, but the east-west corridor and the north-south corridor, was it north-south? Yeah. One of which was being financed by the Japanese. I suppose they're still going ahead, but I haven't been following them. But as you know, there's just so much more to be done in India, from literally port development. And I'm thinking more in terms of seaport development, just to handle manufacturing, container flow, raw materials coming in and out of India, cold storage in terms of the whole rural economy, being able to produce goods which doesn't go bad before it gets to the market. I mean, if I remember rightly, around about 30 to 40% of India's food output actually rots before it can get to market. These are areas that are actually quite simply targeted. They cost a lot of money to produce the goods. I realise that, but I would just like to hear more said about them and more kind of emphasis on special economic zones, another one. And I know there's been a few problems in trying to do the land acquisition. That then brings that one back onto the table as well, although probably not what you would have expected to hear in the budget anyway.
Mm-hmm. Right. So, you talked about special economic zones, and, with global trade shrinking, does a strategy like Make in India still make sense?
I think it does. And I was, when it first came up as one of Mr. Modi's, what would you say, kind of election promises, I thought about it and I thought, is this a sensible thing to be doing? But the truth of the matter is that when you look at a number of Indian industries, including things like automobiles, truck manufacture, etc., despite the fact that they're domestic industries, they are actually globally pretty competitive. And the fact is that, more than anything, I think Indian producers, Indian businesses have a very domestic-centric view of the world. It's a big market, why wouldn't they? But they tend to sell into India by choice, but kind of ignoring the rest of the world out there as a marketplace that they could actually do quite well in. Now, I wouldn't say that I would want it to be the sole strategy. And I don't think India needs to be the next Asian manufacturing export giant. No, not at all. I just think that there's a degree of, what would you say, opportunity that Indian manufacturers and Indian businesses miss by being just too domestically orientated.
One of the things that they're trying to do in the budget is to move the entire subsidy structure of the government towards, they're trying to digitize it and So what are your views on that? How do you see it?
Well, actually, I'm a big fan of this altogether, Vivek. In fact, it's one of the things that we've pushed for the last couple of years in Asianomics. Not just an India story, but a regional story, in fact, an emerging market story. We wrote something a couple of years ago called Asia Connected. And what we'd done it was a year-end strategy report, but what we did in it was we looked at the rise of the service industries across Asia as a percentage of GDP. And services tend to be much more domestic demand orientated than export orientated. So what we were really arguing was that in a period where Asian exports had actually flatlined for 4 years almost, the services sectors were taking over and producing economic growth that was perhaps unexpected given how weak the external segments of the economies were. So this was in commodity countries like Indonesia, etc., etc. And what we came up with as an explanation for the sustained growth was the fact that mobile technology had just absolutely taken off in all of the countries around, the emerging countries around Asia. So from the penetration of the internet to the penetration of mobile telephones, smartphones, where they'd gone from levels in 2005 of maybe 8% of the population having access to the internet. By 2012, 13, 14, whatever the dates were that we had, the internet penetration was up to 30 or 40%. Mobile phones had gone from 15 to 20% to almost 100%. And my thesis here is that this is the new marketplace for emerging markets. In developed countries, the marketplace was a physical infrastructure story. So either you had towns or cities with roads feeding in from the rural areas, you had distribution centres, cold storage, retail markets, wholesale markets. And in communication terms, you had landlines, from way back. Now, you hardly need any of that physical infrastructure. So just as an example, over the border here, one of the worst investments, and unfortunately this happens for a few Hong Kong companies, one of the worst investments in China over the course of the last decade has been to build shopping malls. Mm-hmm. And the reason for that is pure and simple. People don't shop. People buy everything online. They go to Alibaba. And, while that's bad news for the old economy physical shopping malls, the fact is that what it has done is it has enlivened economic activity in all of these countries by giving them a marketplace and an information flow that was never available to them before. Mm-hmm. So the rise of the internet, the rise of mobile technology, I think is completely underappreciated in the global equity markets for the difference that it's making to economic growth in emerging markets. And we've got loads of examples of kind of anecdotal stuff, but it's just transformative of the economy without much of the physical infrastructure that was required before. So this whole move towards the digitalisation of public procurement, the digitalisation of, as I said earlier, subsidy payments or NREGA type payments. I'm a huge supporter of that because it takes the corruption out of the system. Mm-hmm. It specifies where the money flows go, and it makes the system actually much, much more fluid as a marketplace, which is tremendously good news for economic growth.
You recently came up with a report on gold, and obviously down here we are all obsessed with the idea of owning gold. So what is it that gold's not really gone anywhere since 2011 for the last 4.5 years, not 5 years. So yeah. What is it that why should people buy gold now?
Yeah, I mean, it hasn't gone anywhere in US dollar terms. In fact, it's about 30% below 2011 peaks in US dollar terms. But one of the things I pointed out in that report was that, of course, if you were an Australian, gold is only 3% off its all-time high. And depending on what part of the world you're in and which currency you happen to be using, then the gold, what would you say, the exchange rate in your own currency has not been quite as bad as it looks just purely in US dollar terms. But I mean, the main reason for writing that report at this time is basically what's happening in global monetary policy management. I mean, I think it's been appalling for the last 8 years, the ridiculous extremes that central bankers have got away with in terms of their policy positioning. We're now at negative interest rates in Europe and Japan. Banks can't make money under this system. The only people that this is helping are governments. And of course, that's why central bankers keep doing it, because they basically are just part of government. But I think the interesting thing is that since Europe and Japan joined the QE race and the negative interest rate race, equity markets have not performed well at all. And at last, I believe that people are beginning to understand why that should be the case. Because, you know, when the Americans print money and do quantitative easing, US dollars enter the system. I might not like it particularly much as an Austrian economist that believes that sound money should be preferred over just printing things out of thin air. But what I understand is that when Europe does this, what it ends up doing is destroying dollars in the global system. And this is what most people in the marketplace just do not seem to get, especially if they're CNBC or Bloomberg, which completely mislead people all the time on decisions made by the ECB and the Bank of Japan. If next week the ECB decides to increase its quantitative easing policy, the world will get worse, not better, in terms of economic growth. Because the euro will go down and they will shrink dollar-denominated GDP in the global system even more than they have done already. So just to give you that in an example, in the first 9 months of last year, if you added the US, Europe and Japan together and converted them all into US dollar, in the first 9 months of 2015, US dollar denominated GDP from these developed countries contracted by $1.6 trillion. So these are central bankers that have no clue what they're doing. They're causing havoc in their own countries amongst savers, pensioners, and businesses. They're causing havoc in the emerging markets because they're shrinking dollar-denominated GDP and therefore shrinking the ability to export into them. And the result of this is now becoming clear, as I say, in equity markets as share prices fail to go up. I think as more and more people begin to understand what's happening, the emperor's clothes are going to become very apparent. In other words, central bankers are swimming naked. And as that happens, people are going to demand other types of monetary instruments with which to either store value or make transactions. And gold happens to be at the top of the list.
So, talking about central bankers, do you see Janet Yellen increasing rates this year?
She said, Janet Yellen.
Yeah.
Our view has been that the Americans would probably get away with 2 interest rate increases. One was in December, then another one before they had to introduce QE4. I'm not even sure that they get the second one now.
Okay.
So I'll just come back to the point you were making prior to this. What is the scenario? How do you see it playing out? Because central bankers are not holding back, right? They're all doing what they were doing, and now some of them are going negative rates of interest.
Yeah.
When you envision from where you are 1, 2, 3 years down the line, how do you see it playing out? And in that context, from our perspective, How do you see that impacting India?
Yeah, I need to be careful in what I'm saying here, Rahul, because of course I'm going to say the good news is that I don't think their, what would you say, monetary crankism is going to last another 3 years. Now, that's good news for me as an Austrian economist, because I think we'll get back to sounder monetary management and better interest rate environments, which means much higher interest rates, like India has. The bad news is that it tends to be quite negative for equity market flows in the short term. So, as I say, I think the world is discovering the destructive power of central bank money printing at the moment, especially when it happens outside the US. And that's only going to take maybe even another few quarters before it's very apparent that things have to change. What we've argued this year in a piece that we put out in early January was that, when you look at what we used was the trailing book value in Asia, in equity markets relative to places like the US and Europe. The bad news had already been discounted in the price of Asian equities. And that makes a lot of sense to me, because Asia being a pretty export-orientated, and I know India is not as export-orientated, but it's still part of the Asia story. Asia is a relatively export-orientated part of the global economy, tends to be at the early stages of the global supply line, if you like. And if there's problems arising in the global economy, which I firmly believe there are, then the early stages of the supply line feel it first. And I think that's been reflected in Asian equity market prices. And we're now at levels that they normally rebound pretty strongly from. That's certainly not true of American equity prices, which are priced for perfection. So my belief is that there's going to be a decoupling this time round, where even though there's a lot of bad news still to come in developed countries, as regards policy making and as regards equity pricing, I think in Asia, and I include India in this, the equity market bad news is already there. So we'll see outperformance, even though it might not be a significant rise in equity prices. We might just be treading water, and we might even be falling a little bit, but nowhere near as much as the developed countries. And I think that happens over the next 12 months.
What about China? I recently read a column of yours in which you basically discussed a data point saying that in January, Chinese banks lent the most amount of money that they ever have. So, why do they keep going back to the same formula over and over again?
Right. Well, the most positive thing that we can say here is that we need to wait for another month just to get the true picture in China, because, of course, theoretically, January is a Chinese New Year affected month, and it might just be an aberration. The extent of the aberration looks a bit too high, though.
I saw the graph. It just there's a huge difference. So.
3.4 trillion renminbi in 1 month was at least $1 trillion more than they've ever done before. And actually, if you look at last year, not so much the total social financing, but the balance sheets of the depository institutions in China rose dramatically as well, with a lot more lending to local governments in particular. So it doesn't look as if the Chinese have completely weaned themselves off the credit binge that has been effectively ongoing since 2009. And that's quite concerning. It's concerning in the sense that, they're not very good at controlling where the debt goes. And hence the reason that they've got 30% overcapacity in their steel industry, about the same in their aluminium industry, their cement industry, their shipbuilding industry, you name it, industry that's run by the state sectors. There's just huge amounts of overcapacity. The danger is that if the credit keeps going the way that it started this year, we'll end up with even more overcapacity, which then puts downward pressure on prices across the world, and of course much more pressure on profitability in every other country that's actually trying to compete with the Chinese. So it was a disturbing start to the year, despite all the rhetoric about rebalancing the economy and going down the new path rather than the old path, etc., etc., etc. Let's just hope that the money binge reverses in February and March. Not holding out too much hope for that.
No, another interesting data point that I came across was, this was not in your column, but somewhere else, is that a lot of Chinese money is going out of China.
Yes.
What is happening? Because, one reading was that this is like the non-resident Chinese taking their money out of China because they can see the economy kind of going into a tailspin.
Yeah, there's a number of aspects here, Vivek, and it's a difficult one to be too, what would you say?
Clear about.
I think anybody who argues that they know what's going on is being disingenuous, because there's a lot of moving parts here. So, for example, there's definitely external debt repayment
Happening, yes.
We don't know how much this is the problem. But the Chinese are definitely taking the opportunity at this particular point to try and raise domestic funds, which they seem to be able to do just now, and use those funds to retire US dollar debt. Mostly US dollar debt, maybe Hong Kong dollar debt. So there's an element of that going on, and that's not what I would call capital flight. That's actually just prudent debt management. But at the same time, there's no doubt that there's a lot of rich Chinese who want to get some of their assets out of the country because they acquired those assets under rather questionable circumstances. Very kind way of saying they stole the money, and would rather have some of it offshore. So that is pure capital flight. But where it becomes trickier is that if you speak to anybody just now in China, and people dealing with Chinese businesses, Chinese businessmen themselves, wealth managers who have Chinese clients, they'll all tell you the same thing. Nobody in China believes that the renminbi is going to stay at the levels it's at today by this time next year. They're all looking for a significant depreciation. Now, personally, I don't actually think they need to have a very significant depreciation. I think they need to have something. But if everybody believes that that's going to be the case, then you get people taking action on the basis of that belief. And the more money that the Chinese actually print every month at the moment, the more likelihood is that a lot of it's going to escape from China. So, as I say, you've got an awful lot of moving parts here just now, and we don't know which ones are the most important. But there's no doubt at all that they're losing foreign reserves fairly significantly, and that's having a big impact on the monetary conditions within China. Because last year, when they cut interest rates and raised fiscal spending, at the same time, what was happening was that reserve money in the system was actually contracting. So they ended up trying to loosen policy, and effectively they tightened it. And it was all because of an unsustainable exchange rate policy in the eyes of the Chinese.
So, I have two questions. One is the overcapacity creation, is capacity still being created? And, where do you think, what will be the value of the renminbi against the dollar by, let's say, March next year?
Okay. Is capacity still being created? Yes, but not as much bad stuff as was the case over most of the last 5 years. So the ghost cities in remoter provinces, and especially those involved in things like coal mining, general commodity extraction, heavy industry, etc., the ghost cities that they built have stopped appearing in those areas. Would China probably be adding steel capacity this year? I suspect so. but at a much smaller net increase than was the case again over most of the last 5 years. So at least things have tempered a bit. But they're still going to build a lot of infrastructure. The local governments are kind of pushing that at the moment. Much of it will be useless, but it's a kind of job creation scheme just now. But have they got it completely under control? By no means. The renminbi, where do I think it will be by this time next year? Between 7 and 7.2. I think that's a good enough adjustment. That's against the US dollar, obviously. I think that's a good enough adjustment for them actually to end up with significantly, if you like, looser monetary conditions in China than is the case just now. Because what I would do is I would make sure that I got the message across that I would do a one-off adjustment in the currency and send the signal at that point that we are now going to manage the exchange rate against a basket of currencies, not against the US dollar. And our belief is that the appropriate management of the renminbi going forward, given this resetting that we've just achieved, is an appreciation of the renminbi. What they wouldn't do is tell people what the exact makeup of the basket was, and they wouldn't tell people what the slope of the appreciation line was. But by signalling that it would be an appreciating currency, then it would take the steam out of the people who want to get money out of China, because they would be saying to themselves, oh, damn it, we had a chance to get our money out, we've now reset, and we've missed the opportunity.
What about the property bubble? Around a year back, I kind of read a lot of stuff saying that it was running out of steam. But now, again, it seems to have picked up.
Yeah, it's picked up in certain cities. But these were always going to be the cities that you would, what would you say, you would expect there to be a floor on property prices. So, at the moment, for example, first-tier cities, and that's really kind of Beijing, Shanghai, Guangzhou, I don't even know if Wuhan and Chongqing fall into first-tier cities, but first-tier cities have real significant end-user demand for property. So when prices fall, they don't actually need to fall very far before more buyers come into the market. In second-tier cities, it's a similar story, but the price adjustment and the transaction volumes will be a bit more aggressive than in the first-tier cities. And so what you've seen so far in terms of the Chinese property market and the revival in it is that those first and second-tier cities are moving again. They're not moving very fast, by the way, but there's transactions, there's been price adjustment, and now prices have stabilised, and in some of them they're going up slightly. In third and fourth-tier cities, that's not the case at all. And those were the problem areas, because basically all of the property buying in those third and fourth-tier cities was speculation. So it was the same people buying hundreds of units of properties, never intending to occupy them. It wasn't end-user demand. And to be quite honest, the adjustment that would need to take place in those cities to actually get end users in them would probably be 80 or 90% downside to the price.
It's huge.
So they're not coming back. They're just going to, those properties are just going to sit there, unused, store of wealth, well, only if you don't mark to the actual value at the time, you just keep it at book cost. But the good news is that there won't be that much building, there won't be that much activity in these cities anymore.
Would you have a view on the property sector in India?
Not such a clear one. It's always confused me, to be quite honest, Vivek. I've never been able to come to grips with what shall we call it, the percentage of cash paid.
We call it black money here.
Is that what we call it? Yes, right. Okay. I mean, the real estate market in India looks more real in the the sense of actual end user, I suppose, than the China one did. But I don't follow it very closely, to be quite honest.
Okay. Do you have anything else? I think I've run out of questions.
Yeah, so I want to talk to you a little bit more about the bigger picture. I think we've spoken a little bit about India, your views on the budget. We've spoken about central banks and broader. If you completely zoom out, and tell us what looks like the strongest economy for you. Where do you think the future is in terms of, let's say, opportunity, growth? From that perspective.
The funniest thing, Rahul, and it might seem strange because I've usually been considered something of a kind of bearish commentator on economies around the region over the last 20 odd years, coming very much from an Austrian background, of course. But I would say over the last 2 years, I've never been more optimistic about Asia. Now, China has problems, and it has a digestion period to go through that is going to be pretty painful for it. And hopefully they don't do too much wrong on the debt side. But it'll probably still be growing at around about 3 to 5% a year over the next few years. But what I mentioned to you earlier about this penetration of mobile technology and the rise of the domestic demand stories right across Asia. So, the fastest growing part of the region just now is the greater Mekong sub-region. Vietnam, Cambodia, Laos, Myanmar, Thailand, unfortunately, kind of sitting there pulling everybody back slightly, but I think that's temporary. Indonesia looks in pretty good shape. The Philippines have just had their fastest 5 years of GDP growth in the last 40.
Wow.
India, I think, it has been, and we can go back to the GDP numbers, but it has been, if you like, digesting the upcycle that it had between 2007 and 2012 for the last 3 years. And my view is that India is very, very close to the takeoff stage of the next business cycle, which is easily a 5 to 10 year upcycle. Obviously, it needs to be supported a bit by government and by central bank action, but I think it's pretty close to there. And when I look at the Asian region in that context against the rest of the world, and in particularly against the rest of the emerging market universe, I think Asia looks fantastic just now.
And in terms of asset classes, which asset class do you find the most attractive right now from a long-term perspective, from a short-term perspective?
Yeah, I mean, it varies from country to country. That's where you can actually start getting some real value out. Moment, for example, I would be keen if it was easily available to buy, preferably rupiah government debt in Indonesia. There's a 7.5% yield on a currency that I think is was and maybe less so now significantly oversold. And I had exactly the same view of Indian government debt a year ago. And I think it probably would still have the same view. I think the equity stories in a number of the countries around the region are exceptionally strong. Getting to the sectoral level on equities is really not my strong point. I can get there on an economy-wide basis, but quite often the stock markets don't reflect sectors quite as well as they probably should do. India is actually an exception in that case because it is such a wide stock market. But it's the area that I tend not to kind of venture into too much as a strategist, I'm going to say.
Now, I know.
I usually leave that to people that know a bit more about the companies.
So I know I'm talking to you, but I'm going to still ask you, what's your call on gold? Where do you see it 1, 2, 3 years down the line? Do you have a price target for gold?
Well, a price target for the end of this year is $2,000 an ounce. It's 3 years further down the line, I would expect that to at least double.
Sorry, could you repeat that, please?
Yeah, so 2,000 by the end of this year, and then maybe 3 years out, 4,000.
Okay.
Dr. Dim, just couple of questions to close with. Which are your favorite books? I mean, if one wants to.
Yeah, that's what I would ask.
Well, of course, being an Austrian, I've got a lot of favourite books that are by people like von Mises and Hayek and people like that. But maybe more recently, what have I got?
What did you read? Let's say over the New Year.
I read Jim Grant's book, the what was it called? The Forgotten Depression.
The Forgotten Great Depression.
The Forgotten. Yeah, it was a Forgotten Great Depression.
No, it was Forgotten Depression only.
1921.
1921, right?
Which I think is a must read for everybody, just to remind people what real central banking was about. And I think it's very good in that sense. Just looking at my bookshelf, what else did I? There's a new book out which is written by Ronald Stoffel.
Okay.
And Heinz Blasnik, and Heinz writes some stuff for us occasionally, but it's called what's it called? It's Austrian investing. I need to get the exact title. Hold on. Yeah, it's called Austrian School for Investors, and that's a really, really well worth addition to anybody's library.
Mm-hmm.
You read any fiction?
Oh yeah, I do. I like Peter May.
I love Peter May. I love Peter May. I love Anne Rankin. Any Scottish crime fiction is
You've been
welcome.
telling me about that, yeah.
Yeah, I think he's the best of the lot. I mean, I like Rankin as well, but
Peter May.
I like Peter May.
You read The Coffin Road, the latest one? Have you read it?
No, I haven't actually.
You should. It's pretty good. Did you
Is
read?
it really?
Did you read?
I need to get a
You
hold
read
of that.
the previous one was called Runaway. You read that?
Now, Runaway. Yes. That Runaway, was that the one in Canada?
No, this was the one where all these oldies kind of go back from Glasgow to London one last time.
No, I haven't seen that one actually.
So,
I read the Enzo files. Then they had the ones in the Western Isles as well. Was that the trilogy?
That's the trilogy of the island.
What I've been waiting for is that he's actually got a series.
I know, Enzo file.
Well, I've read the Enzo ones, but there's a series that is called Yan and Campbell.
In China.
I've been waiting for, because they've never been published. They're actually on Kindle.
They're there on Kindle.
Yeah, I know, but they're digital. My wife has Kindle. I don't have Kindle. I need the physical book. So I've been waiting for them. They were supposed to start coming out.
They haven't come out.
Around the autumn last year, but I can't find them yet. But I'll need to get Runaway and
Coffin Road.
Was it Coffin Road?
Coffin Road.
Yeah.
Great. I had one more.
No.
So one final question.
Sure.
People you admire. 3 people you admired and looked up to in your life.
Looked up to in my life. My God. No economists then, or actually, I would start with an economist. My old professor, who's written a few books. If you checked out under his name, but a man called David Simpson.
Mm-hmm.
He was a professor at the Fraser of Allender Institute, which is where I did my PhD.
Mm-hmm.
Who else? Good question, actually. I mean, from a historical perspective, in terms of economists that have been really influential on me, Hayek would be there. And he was actually still alive when I was studying and things like that, so he was a living economist as well.
You don't like John Maynard Keynes?
I'm not so fond of him. Not so fond of him.
No, but the tragedy with Keynes is that a lot of what he said has been twisted over the years. I mean,
I'm glad that a lot of what he said has been questioned. I'm just sorry he ever said it. I'm just trying to think of who else. I'm trying to think maybe not about an economist. Well, my old boss actually, Gary Goel, who started CLSA, and he was a wise man in many respects about this business, the kind of investing, fund management, stockbroking business. I always loved the kind of way that he approached Asia, because his kind of key message whenever he joined the company was, we're here as CLSA, a stockbroker, to tell the story of Asia, warts and all. In other words, not just a glorified story, a Panglossian story, the usual investment bank stuff that everything's okay.
well,
It was to tell the story where there were problems as well. And I've stuck to that my whole professional life, that we don't try and say you've got to buy Asia because I live here, and what else am I going to say? We look for the stories in Asia, whether they're positive or negative, and hopefully we tell the truth about them, what I think is the truth at any one time.
Wonderful, great. Many thanks for your time. It's been a wonderful
Pleasure. Good to speak to you.
Thank you.
Okay.
We'll be in touch. Thank you.
Bye.
Okay, thank you.
Bye.
Bye.